Well, in many ways, investors tend to think that the quantitative easing programs by the US Federal Reserve has been one of the key drivers of the market's recovery since 2008. And really, QE programs can help markets if they're dysfunctional. And this certainly was the case in 2008 after the collapse of Lehman Brothers. But once the US Fed and the US Treasury had stabilised US financial markets in early 2009, the economy began to recover. Corporate earnings started to trend upwards. So I tended to think that the contribution from these programs in 2010 and 2012 is probably overstated by markets. Over the last year, there was a bit of a taper tantrum in the markets in September 2013. Since then, the US Fed's been very consistent in its guidance, very consistent in its messaging, and as a result, the markets took the end of the QE3 program pretty well. There wasn't much of a reaction. That's exactly what the US Fed wanted. Well, the global financial markets have certainly seen a lot of volatility in October, and that's traditionally been the case. It's one of the most volatile months in share market history. The primary reason for that is, firstly, the markets were overdue for a correction. It's been around 800 days since the last correction we had in US share markets. So in many ways, investors kind of used events like Ebola, increased geopolitical tensions around the world, some concerns about the global growth outlook, and also the fact that hints were given that the US central bank might be tightening interest rates a bit earlier than markets expected. So those factors kind of combined into the perfect storm to drive markets down in early October. But since then, really the key has been that the US reporting season has been much, much stronger. That's really told investors that the US corporate sector can cope with what is still a weak and subdued global economy. So that combined with a lot of additional liquidity from other central banks outside the US Fed, that's really seen global markets stabilise and then recover nearly all of their losses. So in many ways it does appear that the correction has well and truly been done. But of course, markets don't go up in a straight line, and investors need to continue to prepare for an increase in volatility that is likely when the US Fed starts to increase its interest rates next year. Well, we have to keep in mind the backdrop for the current reporting season has been a reasonably solid US economy where growth's come in around 3.5%, which was much higher than markets expected. Now, to date, around 3/4 of the S&P 500 companies have reported their earnings, and the results have been very, very good. We've had earnings growth this quarter at around 7.5%, which was much higher than what markets were expecting. 78% of companies have actually beat expectations, which is an unusually high number, and the average beat rate's been around 5%. But I really think the key this reporting season hasn't been not only the beat rate, it's been really where the beats have been occurring. There's been a much larger contribution on the revenue side. Now, we've seen a lot of costs out drive in America over the last 5 years. It does appear that the stronger US economy now is starting to filter through to corporate top lines. And because there's so much operational leverage with the cost out drives, a small increase in revenue at the top line can lead to a very sharp increase in earnings at the bottom line. And so I tend to think this is now starting to play out. And of course, this trend's going to be reinforced by a stronger US economy. But at the same time, we are going to have a higher US interest rates next year, and we do have a higher US dollar. So all of those factors really are combining to tell us there are still some question marks, but overall, the underlying US corporate sector remains pretty strong. Well, for 15 consecutive years since 1997, the Japanese economy was characterised by sustained deflation. However, with the election of the Abe government in 2012, he initiated some very broad reforms, including a big fiscal spend, a huge rise in the monetary base for a quantitative easing program, and initiating some reforms. And it is the fact that Japanese consumer prices have lifted since then. The problem, though, with the rise in Japanese inflation is that it's the wrong kind of inflation. It's not the kind of inflation which leads to higher wages, better earnings results, and which eases debt burdens. And really the primary driver of the rise in Japanese consumer prices has been the depreciation of the yen. And this has been instrumental, of course, in lifting Japanese corporate earnings, but that really comes at a cost. And that is, it acts like the lower Japanese yen acts like a tax on discretionary spending because it raises the prices of imports. And the way the household sector has been able to adjust to that is they've actually lowered their savings rates to zero. Now, I probably couldn't tell you the last time where the Japanese national savings rate is below both that of Australia and the US, but it would be pre-World War II. So really that savings rate can't go down any further. So if we're going to get a sustained recovery in the Japanese economy, we actually need to see household incomes starting to rise. And really the reform process to date in Japan really hasn't triggered that. And this is really the, the missing variable in the Japanese recovery to date, and many really question if we're going to get that at all in the next 12 months. So in the end, I tend to think the Bank of Japan has probably done all that they can do, and I think now really the reform agenda needs to move on to the Japanese government, and they seem to be balking at the ideas of initiating big broad-based reforms. And until they do that, we won't get a sustained recovery in even economic activity or consumer prices. But if we did get that, then that would be something that markets could really rally behind. Well, there's no doubt the markets are expecting some pretty large increases in QE programs in both Japan and Europe. When we look at, though, asset allocation between asset classes, I tend to think those programs wouldn't have too much impact on your allocations. The biggest driver of your long-run returns in any kind of diversified portfolio is your starting valuations. Equity markets now at the moment are about fair, whereas bond markets are historically expensive. So therefore we tend to think that the very best return you're going to get in these bond markets is in the next 10 years is the yield itself. So you expect a return of around 2.3% from a US Treasury, you expect about 1.2% from a European bond and around 0.5% for a Japanese bond. So I tend to think that the outlook is probably more favourable for the equities than it is for the bond markets on a pure valuation perspective. When we actually look at a country allocation, now naturally you would tend to think there'd be more upside in the growth assets in both Japan and Europe. They're not only cheaper than the US markets, but they're going to be the markets which are obviously most supported from any kind of central bank action. But when you look at the US market itself, it's a much stronger economy. And so therefore you'd expect a better earnings growth from the US corporate sector. So in many ways what this really tells us is that there are some favourable macro currents, but at the same time the key in a diversified portfolio is going to come down to your individual stock selection. And with that we tend to continue to focus on companies with very strong balance sheets, those with those robust operating models that can defy what is still a pretty subdued economic recovery.